Okay, good morning, everybody. This is the Monday, week 13. So I want to sort of bring you back to the syllabus here. Obviously, this is a week looks like it's vacant. It's not really because I deferred the activities for chapter 15 as homework, quiz, and bonus to this coming Sunday, the 24th. And we're still actually talking about chapter 15. So and I'll probably get my expectation is I'll probably get all the way through, except for maybe the final module, which is not, or the final segment, which is not particularly large. So when we come back on Wednesday, what I'll do is I'll finish up discussing chapter 15, what it's all about, what some of the basics are, and then do some homework, quiz, and bonus, or I'm sorry, some homework, quiz type activities for the back of the chapter, which should be pretty good, which should pretty well resemble what you're going to see for this week's activities. Okay. So it looks like we've got a couple of people here on the Zoom link. Anybody questions? Anybody have any questions for me before we get started here? Okay, well, if you do, just kind of sing out. And so what I want to do is this. I want to pick up from where we are. So we're talking about budgeting. Budgetary planning, or budgeting is for short, is really what we're getting at. And we've talked a bit about the budget process. And I want to sort of go back here just a little bit in order to go forward. And that is, there's a particular slide that in the PowerPoint package, which you see in your Brightspace module, which I think is really sort of the seminal slide here. That's this idea of what is the overall flow of the process. And I'm going to be referring to this again and again and again, particularly today, because we're going to sort of go from taking these number one, sales, which then it goes to the production budget and these costs, to the more fixed costs, and build the income statement, which is a budgeted income statement. It's not a historical income statement like what we saw in Principles 1, where an income statement is basically for some prior period. This is a future-looking income statement. We call it pro forma. It's based upon the future expectation. So we're going to get to that today, but just notice the kind of flow of these, because again, everything starts with the sales budget. We talked about that. And then the production budget is more numerically oriented. Like, what do we have to do? What do we have to produce? What is it that we've operationally got to do to meet these sales goals? And once we know this, then the cost of this production, which really is the cost of goods sold, direct materials, direct labor, manufacturing overhead, can go into that. Those are all product costs, as we've seen before. Then we get to the period costs, selling and administrative expense. I know this looks like one little square here in the entire flow chart, but it's actually it can be a very large line item. In fact, series of line items on an income statement. Salaries, it's depreciation of the building, it's insurance expense, it's employee benefits for the people who work in the headquarters, for instance. It's advertising, it's shipping, it's all these marketing, it's all these kind of activities. So this is not just a simple throwaway item here. But from there, we have product costs and period costs, which are these two categories of costs in terms of how they interact with each other and with the product or not, because period costs do not interact with the product. Then we can create a budgeted income statement. And then before we leave, I think we'll sort of leave this overall category of what we call operating budgets. And operating, whenever you heard the term operating in business and accounting, it's almost always referring to something in relation to producing output, selling goods, making goods, generating revenue, incurring costs. And that's really what's going on. It's the day-to-day kind of thing. So in a lot of companies, the chief operating officer is responsible for keeping this between the lines and is creating the output, controlling the costs, creating the net income that's desired and budgeted for in the budgeting process. And then there's the financial budgets, which there's a little bit less, and we're not really going to get much of this at all. As I mentioned earlier, I think last week, that the capital budget is really more something we get into more in finance courses. You'll get to that a bit later. The cash budget that we will talk about, and the cash budget is this idea of saying, okay, all right, these are balance sheet items, right? Cash is a balance sheet item. It's not operating. It's simply having the cash on hand to fund the activities that we're doing. How much do we need? And this is not a simple question. And as an ex-banker, I can tell you that a lot of my clients, borrowing companies, really struggle with how much cash do they need at any one time. And it's not the case that they fail to make proper estimates and therefore have to borrow. They may have to borrow anyway, just to simply get them over a seasonal downturn, not an overall economic downturn. But simply, it's difficult to budget. This is not easy. Nothing in this particular module of the course is easy. And from there, building a budgeted balance sheet. We're probably going to get this more on Wednesday, and sort of take that as a jumping off point to doing some of the back of the chapter exercises. Okay. So anyway, that's sort of a brief review, I guess, a preview. And so remember, and by the way, that slide that I just got to, I think I would, if I were you, I would print it or save it or something, because I really think it's an important reference point to sort of, because I really like it because it lays out the overall process, particularly separating the two types of budgeting activities: operating budgets, which have to do more with the income and costs, or revenue costs, and generating net income as a result of the difference between those, and then the balance sheet items, which we're going to get to a bit later. So I think it's something that you want to somehow save and have available as you work on this week's homework quiz and bonus. Okay. All right. So beyond to go back here real quick, and by the way, I should mention too, as every time I prepare for this course, I sort of try to remind myself that we're going to be doing a lot of flipping around back and forth, simply because it's a way of saying, where did this number come from? From what individual subsidiary budget did this number come from? Maybe it came from direct materials. Where did it come from? Here. And it goes to the budget income statement, right? Or direct labor. Where did that number come from? So this idea of referring to other sources is really an important piece of the process. And I think that's what we should be looking at. So here, as of last week, we finished up talking about these product costs in the operating budget category. Now we're going to go to the period costs of selling and administrative expense. So let's get to that. Now, selling and administrative expense, it will be, as I've said many times before, I think it would be nice if everybody in accounting would have one term for one topic and leave it at that, and not have all these different terms. These are sometimes called general administrative expenses, or G&A. Sometimes they're called fixed costs because they're mostly fixed, but they're not really always fixed. So that's probably an insufficient term. But selling and administrative expenses is one way that you see it. And sometimes on income statements, you'll see selling expenses broken out from administrative expenses, because the idea is that they're completely different things. And by the way, selling expenses really refer more to how we sell the product. It's commissions, it's freight out, it's marketing, it's advertising, all those kind of things. None of which really resemble some of the other administrative expenses, like, rent on premises, lease expense on furniture, all the stuff that's in the home office, those kind of things. Okay. But nonetheless, if we lump these together as one category, which we're doing here, it's really trying to project what's coming out. Remember, budgeting is a forward-looking process, whereas reporting is a backward-looking process. This is something I can't emphasize enough. In 2110, or Principles 1, we talked a lot about how we prepare financial statements for external users, and we do it according to some uniform guidelines, and they're all historically based. In budgeting, in managerial accounting, this is forward-looking, and some of it is communicated to outside users, and I've talked a bit about that, particularly what we call the top and bottom line, sales and net income, top line, bottom line. But for the most part, the details and all the work that goes into the schedules and the individual budgets, those are really internal documents, not to be shared with anyone else. So in this case, we're going to distinguish between fixed and variable cost. Not a particularly bad way to do it. And we're going to say the variable expense per unit of sales are commissions of $3 per unit and freight out of $1 per unit. Now remember, freight out is not an inventoriable cost. In other words, it's not a product cost. So this is an important thing to remember. And this may be, you may not be remembering this from Principles 1, but freight in, if we're the buyer of goods coming in and we pay the freight, those freight costs become part of the product cost. We just absorb it into the product cost itself. Freight out is not a product cost because the product is done, the product is finished. And so therefore it's just a cost of doing business that we simply lump together in these non-product costs, these period costs. So freight out is generally not included in product cost, unless the firm wants to do it. And there are companies that will have all kinds of variations on how they do this internal accounting. Sometimes they'll include sales commissions because they think it's all part of the product cost. It's entirely up to them. For the most part, though, managerial accounting does not recognize those costs as being product costs. So in other words, variable expenses for the quarter, and we're going to do 1 quarter. Remember this, I think this is the Hayes example. Yeah, Hayes Company, 1, 2, 3, 4 quarters. And it was based on unit sales from the sales budget. So we're going to go all the way back to the sales budget. Remember, it was like 3,000 units to be sold in the first quarter. It ramped up throughout the year. The production budget was higher than that because we have to leave some extra as ending inventory to become the beginning inventory the next quarter. That's just this idea of slack that we have to build into the system. So we expect sales in the first quarter to be 3,000 units. Okay, and the fixed costs are based on assumed data, which we're going to be given here. We don't have to make it up. We don't have to calculate it sort of there. So here's the expense, the selling and administrative expense budget. And so again, we go back here, and this is let me see here. We go back to this idea that we are trying to create sales. So if we go back here to manufacturing overhead, okay, and we're going to have manufacturing overhead as part of, well, I guess we're not actually. So, oh, I know what I was going to say here. Let me just go on here. I think there's a reason why I want to go back. But let's just take the sales administrative budget. Starting with the sales budget, way back, where we had 3,000 in the first quarter of sales of units. These are not dollars, these are units. So again, this is not a financial statement because it's financial statements are prepared with dollar figures. These are numbers, right? We'll get to the dollar figures down below. These are the numbers, right? 3,000 units, 3,500, a ramp up. So at the end of the year, 15,000 units are sold as projected for this particular year. Sales commissions were $3 per unit. So 3,000 times 3 is 9,000. 3,500 times 3 is 10,500. And freight out costs are $1 per unit. So if you simply add these up here, we have 12,000 of variable expenses in relation to the amount produced, okay? The amount sold. And then we have fixed costs. Now, one thing I wanted to say here was we have advertising, and notice that the fixed costs are fixed all the way across. This is why they're called fixed, is because they're not expected to change throughout the accounting period. Now, in reality, this may be a little bit oversimplification because all these line items are fixed all the way across, whatever they are, whether it's salaries, sales salaries, office salaries, depreciation on things like computers and furniture. And there may be some fluctuation in that. But the key thing about fixed costs, remember, going back to the definition of fixed costs, is they don't change with the level of output. They may change, but not significantly, and they're not tied to the level of production. So in this case, we've kind of got an extreme example where nothing changes, and so as a result, we add up all these fixed costs for the first quarter, second, third, fourth, etc., all the way across. One thing I want to point out here was the idea of depreciation and salaries and how those are not overhead. And if you go back to manufacturing overhead, you've got here salaries and depreciation. But how are these different? How are these different? How are salaries and depreciation different in the context of manufacturing overhead than they are in terms of selling administrative expenses?
Is it kind of like what's depreciating? It's like if it's manufacturing equipment depreciating, it's
right, exactly. So if the equipment that's involved in production, that would be depreciation. That would go into overhead. Also, salaries, same deal. If it's production salaries, and we think of supervisor salaries or plant managers or quality control inspectors, whatever, those would go into overhead. They do not go into selling administrative expenses. Remember, one of the things, and we go back, and I know I'm sort of going, I sometimes go back to earlier discussions in this class, but remember that we differentiate between line and staff personnel. And so when we talk about salaries, these are mostly staff personnel. Remember, line personnel are those people who are engaged in producing the product or working directly with customers, primarily producing the product, right? Particularly in manufacturing context. Okay. And so as a result, when we talk about selling administrative, these are people who are not really involved in making the product at all. So as a result, they consider period costs, not product costs, unlike the personnel involved here, where we capture their salaries as being part of the production process. And because we may produce multiple products over multiple facilities or different production runs and whatnot, we've got to sort of spread these out. And we have to have a rational way of doing it to attach them to the product costs themselves. And whatever method we use to do that, which is not necessarily made clear here, the idea is that we want to make sure that those costs go into product costs and not to sort of general administrative costs. Okay? So adding these up here, and remember the revenue, I think it was 900,000. It seems to be that was from the sales budget for this particular example. So we have 42,044 all the way across. We have these red numbers, and we get 180,000 for the selling and administrative expenses. And those are mostly fixed, I think, for the most part. I mean, the variable parts of these are just simply linked to the product itself, but they're not production costs. So now, all right, now is the sort of the piece where we pull all this stuff together, okay? And this is really an important piece of the puzzle. And remember, we want to go back to, well, first of all, what are we doing here? We're going to produce an income statement. It's going to be a forward-looking income statement. It's going to be a projection of what we, the company, expect to do in the coming accounting period. And really, as I've said before, a one-year budgeting process is more effective than something very, very long-term. Too many things can happen in the long term. So a 1 year, which is a very short-term nature, is probably a more realistic scenario. So where do we get the numbers to produce the income statement? Well, think about this. They come from the operating budgets. Remember, operating information has to do with producing income. Revenue, which is then taken out from, which is then deducted by expenses to produce net income. But where do these operating budgets come from? Sales, which is where it all begins. Production, which is what we need to do to get to the sales. And then what do we need to do to pay for the production? Direct materials, direct labor, manufacturing overhead. That troika of product costs. Those are categories. Those are not individual line items. Those are categories. And then we have the final bit, which is the operating expenses, which are non-product cost related. Okay. So again, just to kind of go back to where we are here, we start with this idea of the sales budget, production budget flows from it, and we get to these other budgets. We have the sales budget itself. So remember, and I told you guys earlier on, we're going to be sort of flipping around a little bit, and I really think this is the best way to understand this, is to kind of have this sort of interactively. It's a good thing we've got this stuff together. I probably couldn't do it on a whiteboard. So 900,000 is projected sales for the year based on our sales budget. Where did that come from? Well, it's what management realistically expects is going to happen. We don't know if that's going to be true or not. Things do happen, but that's where we expect it to happen. The production budget, again, is based upon, there are no dollar figures on here really, other than the fact that we have an amount of production in units that differ from the amount of sales. And the reason why is because we've got to have 20% of next quarter sales available as ending production, unit production, so that we can have something available to be produced and to be available for the next quarter, right? So it's 20%, so 700 is 20% of 3,500. These are units of sales. 800 is 20% of 4,000. We did all this the other day, but you get the idea. And then we have some beginning finished goods, which we inherited from the previous quarter. So 700, which is the ending finished goods for the first quarter, becomes the beginning finished goods for the next quarter, just like 800, which ends the inventory, the finished goods for the second quarter, becomes the beginning inventory for the third quarter. And we kind of went through that, but those are the numerical production units that we had to produce. And it resulted then in a direct materials budget, which is based upon the facts given. And again, I don't want to go line by line through this because we sort of went through it, but it's all sort of encapsulated within this slide presentation where you had 2 units of direct materials. I think it's pounds, I guess, was measured in, and we ended up with this budget. So 124.8 for direct materials. That's one piece of product cost for this particular amount of production that we expect to be producing. Then we had direct labor. And direct labor was relatively straightforward. Even though I said that it was maybe oversimplified because it assumed a wage rate that was constant, and let's not worry about whether this $10 per hour is realistic. It's probably not, but that's not really the point. The point is, the bigger point is that we are vastly oversimplifying the picture, because assuming that all wages are the same, and all output all labor input is going to be the same. Let's not worry so much about that. And by the way, labor, in my opinion, is always the easiest element to calculate. I mean, businesses have long had very good systems for capturing labor input. Maybe not always the best for capturing where labor is at any one time, like if we're using a job order costing system, but we do a pretty good job of capturing that. So this is not really that complicated. But most businesses have a pretty good feel, almost instinctive feel, for how much labor is needed to produce whatever is expected, knowing that they may have to ramp up labor at some point, hire new people. And some firms are always in a hiring mode. There are reasons why HR departments exist to hire people, is because there's going to be turnover. People are going to leave. People are going to retire. People are going to die. They're going to leave. And so we need new people coming in. So that's part of the picture. So in this case, we added the direct labor all the way across. Units required per unit of output and the wage rate per unit. And we get 308 as the second leg of the product cost. Okay. And then we come down to manufacturing overhead. And I really don't want to go through all this again because we did this, but then this is the third category here of product cost, which ended up as 246.4. So all I'm saying is that my main point here is the idea that these individual subsidiary budgets are linked to the broader budget, all of which ties into something called the master budget, which is simply the final document that's sort of presented to everyone and said, this is it. This is our game plan, okay? Assuming that we're comfortable with the game plan, and that's the master budget. Okay, so let's take these, all these individual budgets, and including the sales administrative budget, which 180,000, which we got to avoid. Let's build an income statement. Before we do that, though, we need to get the cost of goods sold. So we have determined total unit cost of producing one bicycle seat. I guess it would be bicycle seats. I was thinking bicycles, but I guess it's bicycle seats. Doesn't matter. There are a lot of companies out there that make, just weird pieces that go on other things. So in this case, we have, if we go back to all the foregoing material, it took us 2 pounds of materials, whatever the materials are, at a rate of $2 each, or $4 each, $8 per unit of output. And then direct labor was 2 hours. We just talked about that at $10 an hour, $20 per unit. And then overhead, which we absorbed, and we said that it was going to be $16. So $44 per unit. We're going to produce 15,000 units. That comes from the sales budget times $44 gives us 660,000. Okay, that's the budgeted figure. And right now, I should tell you that this seems maybe a little bit unsatisfactory because, and I know students have said, wait a minute, all you're doing is saying that you're producing a projected income statement based upon this, but what if things change? Well, they will change. That's part of the problem. They will change, but you have to have some sort of game plan, particularly if you, build in some flexibility here. There are going to be some changes. So 660,000 is projected cost of goods sold. Now, how is this different than total product cost? It's a lot different because we're talking about the goods which are sold, not produced, but sold. Okay. Remember, we're building income statement here, which is a GAAP prepared statement, even though this is not going to the external world yet, because we only produce external information, or I'm sorry, historical information to external users in the GAAP format. This is all budgeting information. This is all captured internally, okay? And having said that, I know that sometimes there are elements of this that do get reported to the outside world, particularly in terms of the top and bottom line of sales and net income, and all these details, these individual details as cost of goods sold, selling administrative, direct materials, all that, those are all sort of they're sort of baked within and held closely because number one, it's fairly strategic information, so we don't want to get out there. So an income statement is not a production schedule. It's not an internal document. It's more of something that we would expect to be presenting to the public at the end of the accounting year. So here it is. So remember, sales was 900,000, went back to the sales budget, right? Cost of goods sold, which we just calculated, is 15,000 units, which were arrived at in the sales budget, times $44 per unit that we just got to. So 660,000, 900 minus 660 is 240. That's gross profit. And what I like about this is that it's really, even though it's not really that well delineated, it's the emphasis on the three-step income statement, where this is the top section: sales minus cost of goods sold equals gross profit. That's the first section. That's the operating section. Okay. Then we get to operating costs, selling administrative, which we said was 180,000. So 240 minus 180 is 600, and that's operating income or income from operations. Same thing. That's the second category of the income statement. And then the third category of all income statements, and I know income statements vary. Sometimes they include weird items just unique to the industry or the firm itself, but they all have the same basic flow, 3 tiers. This tier, and then finally non-operating items. Interest expense is going to be earned whatever we do. $100 paid. And this is not earned but paid. Interest expense. We have income before taxes, and then we have income taxes coming out of that. And again, we are not really getting into how we compute taxes. And so we arrive at the bottom line, net income of 47,900 for the year. Okay, for the year coming up. And I know it looks like we have, 47,000 is not a particularly large number for a company, but it's only 900,000 in sales. And by the way, if you're a small company, maybe some of the administrative expenses are the salaries of the owners themselves. And so this may be just sort of extra income that arrives on the doorstep of the business itself. So it's something to really think about here, is how we sort of arrive at these numbers. Okay, remember 180 is the selling administrative expense. So that's how we sort of get to the idea of preparing the budgeted income statement. This is where the company expects to be at some end of the next accounting period. This is also, even though it's presented sort of organized in a GAAP format, this is generally not shared with the rest of the world. What is shared usually is this: sales and net income. And usually net income it's before or after tax, doesn't matter. They have to make clear whether it's before or after tax, but top and bottom line, that's what's shared. And then as we go forward, assuming that we're talking about a publicly traded company, which is really the emphasis and the focus that most college accounting courses take, that there's an expectation that the company make these particular objectives. And if they don't, they need to explain why. And it looks like, remember, there's a quarterly accounting period, quarterly reporting period. If it looks like they're not going to make the numbers, they should announce ahead of time so that there are no surprises. That's sort of it's sort of an axiom or a rule, I guess, in corporate accounting. Okay, in corporate finance. All right, any questions about that? Okay, so the budget income statement includes what in terms of getting to it? Sales budget, yes. Selling administrative, yes. Capital expenditure, direct labor, no, yes. Well, we haven't even talked about capital expenditures, so that must be the right answer there, because we haven't talked about the capital expenditures budget yet, and we're not going to get that deeply into it here. There are some other considerations that have to be taken into account. Some of the things which we're not really getting into in this course, because dealing with things like interest rates and cost of capital, what it costs to borrow, what it costs to pay shareholders, some of which we don't really get into here. So the right answer there is capital budgets. Okay. All right. The Do It example here is the Soriano company. Remember, we're doing sort of two examples. Hayes, the company that makes bicycle seats, was the sort of the main event. This is sort of a sidetrack, but it's good stuff. And what I like about this is the numbers are a lot bigger. It makes a lot more sense. A company that generates 47,000 in net income can't possibly be a publicly traded company. But let's overlook that, and if we want to tack on 6 zeros, we can do that. And the Soriano example gives us a little bit more realism here in the sense of big numbers. And that's, I think, what we have to remind ourselves is that we're talking about pretty big numbers here, which necessitates the importance of getting it mostly right. Knowing, of course, that we're not going to be perfect. No one is perfect, and no budgeting process that I've ever seen ends up on the same figure. We have variances. And by the way, this concept of variance is going to be sort of the last bit that we talk about, because after this, we only got one more module in the course. And we'll talk about this idea of how we sometimes think we have it right, but maybe we're off a little bit. We're human, there's going to be errors. We just have to deal with it. I know it's very unsettling. A lot of people like to think that we all have it figured out. And to the extent that we do, but sometimes we don't. So back to this example. Soriano Company is doing its budget income statement for 2025. Relevant data pertaining to sales, production, direct materials are back in the previous. We can kind of flip back to that, but I don't want to jump too far back on this example here, because I want to focus on this idea of capturing these unit costs. Half an hour for direct labor per unit. Labor cost of $15 per hour. So in other words, 1/2 hour times 15. Overhead at 25 per unit, or 25 per direct labor hour. Remember that they were using traditional overhead costing system where we take labor as the driver, right? Selling administrative expenses, which is given at 12 million, and calculate the budgeted total unit cost and do the multiple step income statement. Remember, the multiple step income statement is that 3-step statement that even though it's not prepared for external use, it is nonetheless something we can use internally. So taking the information given, direct materials, 3 pounds at a cost of $5 per unit. Oops. Direct labor, remember, is 1/2 hour at a cost of $15 per hour. And then the figure for manufacturing overhead is $25 per unit and 1/2 labor hour. So as a result, $35 is the unit cost. So we go back to the sales budget here, which goes all the way back to here. This is the Soriano example. The sales budget was $61,500,000. Remember, this is the example from the end of segment cutaway deal with Soriano. Not the Hayes example, but so 61,500,000. And remember, it's based upon the idea that we'd sell this number of units, derived from the sales budget, and then later the production budget, right? This is the sales budget, and the production budget will deal with what the costs are involved, but this is what we project. And we expect $50 per unit for the first 3 quarters and a price increase in the 4th quarter. So we had 61,500,000. That is the amount that we expect to earn in sales. Okay. So, and then cost of goods sold, we say $35 per unit, which is this. Remember, unit production costs are those 3 categories: materials, direct labor, manufacturing overhead, based upon the level of production. So the unit cost, individual per unit, is $35 to make whatever it is we're making. Right? I don't remember what it is that we're making, but $35 per unit times the 1.2 million units gives us cost of goods sold at 42 million, gross profit of 19,500,000, and selling administrative expenses, which were just given. We don't know what they are. It's not broken down, it doesn't matter. And so we have net income of 7,500,000. And notice here, we do not have a tax expense. We don't have any non-operating items like gains, losses, interest expense, interest income. It's whatever is there is what's reported. So in this case, it's net income on a pre-tax basis. Okay. So that's just kind of another view of how we get to this idea of really the final document in the overall scheme of things, which is the idea of producing operating budgets. Operating budgets, when we talk about the budgeting process, we have 2 categories of budgets: operating budgets, which is all this in the blue boxes. Those are all based upon income statement data, production data, sales and production data. In other words, operating data. What is, when we talk about operations, we're talking about selling things and making things and earning more from what we sell and what it costs us to make, right? That's, I think, pretty straightforward, but that's the entire category here, okay? And it results in the final document, which is the budget income statement, which really is, I think, sometimes the most important thing for external users to know, even though they may not know any of the details that go into it, because I think I've tried to make the case that there are lots of details. The details really matter as to how we get there, but it's not really something they will delve into. And as I've said before, in financial reporting, in terms of reporting to external users. Sometimes companies will try to be as vague as possible while still adhering to the requirements of the profession. Okay. All right, so let's move from there to the financial budgets. Okay, and the first of these are the cash budget. So let's talk about what a cash budget is. Okay, remember, it is one of the main events when it comes to the financial budget. These are balance sheet budgets, really, for the most part. Capital expenditure budget, we'll get to in a little bit. Things like equipment, machinery, facilities, buildings, land, whatever. The cash budget, though, is really pretty intimately related to the operating budget, because what do operations do? They kick off cash and they burn up cash, right? So understanding what the cash inflow and outflow is really important. And then the budget balance sheet, which is sort of the counterpart to the other of the two main financial statements, the budget and income statement. So these are all financial budgets. So let's get to the cash budget and talk about what's going on. And we're going to come back to our example of the Hayes Company making the bicycle parts. And so we'll talk about the cash budget and the budget balance sheet. So what does the cash budget do? Number one, it studies cash flows. And cash flows is a tricky subject because it depends upon what we refer to when we say cash flow. Because cash flow is sometimes construed to mean all the net income of a company, adding back all the non-cash expenses we've taken out, like depreciation and amortization. So that's true. It's a cash flow figure, and it ties over the cash flow statement. But that's one of the GAAP reporting statements for financial statements. That's not really what we're talking about here. What we're talking about is much more basic, and that's money in, money out. I don't know any other way to say it. In other words, cash receipts, cash disbursements, money in, money out. And then any kind of leverage we might use, like going out to raise money from stockholders to sell new stock to them, or to borrow money, whether from a lender like a bank or from the bond market, and then also paying those back, which would be part of disbursements. And so we say these are more operating activities, and this is more of a financing activity. Now remember, and I'm going to sort of take you back in the Wayback Machine back to 2110. Remember, the cash flow statement, which is not really what we're going to get into here, had three categories of activities: operating activities, investing activities like buying equipment, inventory, and whatnot, and financing activities, which is really the effort of going out to outside parties to raise capital or to pay them back for their contribution to capital. Well, we're not really going to get into that so much, but the impact on present cash flow to build a balance sheet, not a cash flow statement, but a balance sheet, is going to be informed by that. So in this case, this is a very generic example, extremely generic, where we start at the beginning cash balance, and there are no dollar figures here. We have the receipts, money coming in, it's money inflowing, right? That gives us the available cash throughout the accounting period. And minus the disbursements, again, no dollar figures, gives us any excess or deficiency, in other words, some surplus or shortage of available cash, and then any kind of amount that we need to go borrow or raise somehow. Remember, companies can raise long-term capital either by borrowing, either from a bank or the bond market if they're big enough, selling stock if they're big enough, to plug the gap so that we end up in a desirable ending cash balance. And we'll talk a bit about the idea that a lot of companies have pretty firm policies as to how much cash they should have on hand at any one time. It's really important, and I know that I think it was chapter 5 in this same text, which is used for 2110 as for this course here. There's a lot of talk about what cash policies are and how we manage cash. And there's the person responsible in a publicly traded company is usually the corporate treasurer, whose job primarily is to make sure that cash is available to do things. If you run out of cash, it's a serious problem. You can't do that. I mean, obviously, I don't think that's a huge revelation that running out of cash is a problem, but it's a bigger problem in a company because you've got employees to pay, suppliers to pay, all these kind of things. Okay, so on the receipt section, we're talking about number one, most basic source is revenue, selling things, right? That's what revenue is. the generation of income from, or of inflows from selling the product. And they kind of expect interest and dividends, which are not non-operating items. These are very low in the income statement because we're not in the business of earning interest and collecting dividends. We're in the business of making bicycle seats, right? Proceeds from any planned sales and investments. We sell things, generate cash. We sell assets like plants and whatnot, and any kind of capital stock that we might sell to raise long-term capital for a business. Okay, but will be represented in the form of cash. All right, that's the income, that's the receipts section, that's the money in part of it. The money out part of it is what we're doing with it. So, and it's, again, we go back to the operating items because remember, and this is, as I said a minute ago, that the cash budget has a lot more interface with the operating items than does the capital budget really. Even though they all have, interplay, this is much more important. So you have cash payments for direct materials, direct labor, overhead, selling administrative expenses. Those are the operating expenses of the company. And if we deduct all these, we get to operating income, but those are disbursements that are necessary in order to fund those. Also, any kind of payments for taxes. We haven't talked very much about taxes here, but that's a non-operating item. Very low in the income statement. Any dividends that we have to pay out. But dividends are not an operating item. Dividends are a distribution of capital. If you remember this from Principles 1, dividends, I know they're sort of tied to net income. So it kind of confuses when we say dividends are related to net income. If income goes up, maybe we raise our dividend, maybe we cut our dividend, income goes down. But the actual accounting transaction is a distribution of capital. But a distribution of capital means a distribution of cash. So it's a disbursement of cash. And any kind of investments we may make in whatever we're investing in or assets and whatnot, those are all uses of cash. So we had, if you don't like inflows and outflows, then look at it this way: sources of cash and uses of cash. Inflow, outflow, right? Okay. And then any kind of financing, which is any kind of borrowings and repayment of the borrowed funds plus interest. And we're going to get to an example here in a second of where we borrow money and we have to pay it back. That's part of the deal, obviously. And we have to pay it back with interest. So let's talk about what some of the general ideas behind the cash budget. Number one, it comes later in the process because the operating budgets come first. And I can tell you that in my experience in doing corporate budgeting, lots and lots of time is spent hashed out and stuff. What it is we can do, and it's a lot of debates internally among managers as to how much we can produce, what we can sell for, and how much what it's going to cost us to do all these things that we plan to do. And then we get to the end, we have an income statement and then a cash budget. Now, in some cases, a cash budget, if you're a company that's very flush with cash, this may not be that critical of a thing. If you're a company that runs thin on cash, because why? Extreme seasonality, right? The ski resort is probably very thin on cash in July, August. But it's probably okay because what do they have to pay? They probably don't have very much wage costs. It's things like insurance, other operating expenses, maybe property taxes, that sort of thing, but not huge operating costs like labor and all the operational, the cost of sales and other ones. So it really depends upon what a firm's needs are as to how critical this overall piece is. But in general, what are some of the theoretical ideas? Number one, they've got to be done in order, and that is the operating budgets are done first, and then we're going to take the ending cash balance of one period, which becomes the beginning cash balance for the next. Not a new concept. We've been seeing this even back in Principles 1, where the ending inventory, for instance, of one period becomes the ending inventory for the next. Cash ends 12/31 of 1 year on January the 1st. At midnight, it becomes beginning cash as we start a new motion picture, which is the operating cycle, right? And then all that comes is informed by the other budgets. And so this is why it's got to be sort of communicated to the people who are managing cash. This is sometimes an issue because a lot of companies don't like to share information, and that's kind of a problem. And I know that sometimes managers will say, I need the information that from the other budgets. And sometimes, for whatever reason, human nature, they want to sort of hold back on getting the information, but they've got to be available. We've got to get other budget information. if this doesn't tie together, it doesn't make sense. And what's the point? I mean, all we're doing is we're a bunch of clowns if we're not putting this all together and having one coherent plan for the year. It doesn't mean the plan's gonna work, things can happen, you know? And as I mentioned before, the September 11th terrorist attacks, the very next day, our bosses said, forget the budget, it's done. It's not gonna work out for the year. And we were late enough for the year, it was the issue of, we'll pick it up in January, we'll figure it out, right? And we'll plan for the next year based on all these changes that were made. These things happen, right? It's done on sometimes on a monthly basis. I think this is important. So a lot of expenses are paid on a monthly basis. A lot of employee benefits are paid on a monthly basis. A lot of payroll is calculated monthly. A lot of employee benefits and whatnot. Things like lease expense on equipment, mortgage payments monthly. So we can break it down, not from the annual down to quarterly, but often to a monthly basis. And sometimes I've seen cash budgets that have on a daily basis where you've got 365 days all the way across in a gigantic spreadsheet telling or projecting for the treasurer what the expectation is going to be for the year. Okay, but it helps to manage cash more effectively, and it also shows, and we'll get to this in a second, when or if outside financing is going to be needed. And here's the thing that we should talk about and be very clear. It is not a sign of weakness on the part of a company to go borrow money, particularly from a bank, particularly for short-term needs, right? As I think I've said before, that at minimum, a company probably, if you're of any company of any size, will probably need some kind of line of credit set up with banks, even if you're very large, if for no other reason to make sure to guarantee that you can make payroll. I mean, I don't think it needs, I can't overemphasize the idea that not paying workers on time is a very big deal, right? And yet sometimes companies run short of cash because maybe they have unexpected disbursements, maybe weaker receipts, maybe the receivables aren't being collected at the speed that were anticipated. The number of reasons why a company may be short of cash are long, but there's no sin in having some sort of facility available just to meet payroll needs, right? And so a payroll line of credit dedicated just to that, you just cannot skimp on this. It's just a big deal, right? And even if you're a company entering bankruptcy, you still have, you know, one of the key creditors are employees. And so being able to pay employees is important, okay? And then in case where excess and a shortage, right, both. This is, I kind of added my 2 cents here because sometimes, yes, we have an excess, but oftentimes there's a shortage, which kind of goes back then to the idea of why a company would need to borrow. So to do the cash budget, then it's a schedule. It's important to do some sort of projected schedule for collections from customers. And it's based upon the following assumption. So in this case, and these are the assumptions that are going to build the framework for how the cash budget for this example is going to be built. And it's going to be that 60% of the quarter's sales are going to be collected in that quarter, and then 40% are going to be collected in the following quarter. Remember, a lot of companies sell to other companies, and they don't sell for cash; they sell on credit. So we have a sale and an account receivable being generated, and the account receivable is sometimes not collected that quickly. That's part of the landscape of doing business with other businesses. And so the assumption we start out with, which the accounts receivable are 60,000 as of December 31st, 2024. Remember, we're doing 2025 budgeting, right? Which in this case, the years are sort of lining up with our own experience, and they're expected to be collected in full in the first quarter. So we have some carryover. We had sales in the fourth quarter. We didn't collect, but we understood that we weren't going to collect it because we only expect to collect 60% in that quarter. We collect the rest as we go forward. And we're also generating new sales and collecting those and deferring more revenue collection. So what's the following assumption? It assumes no allowance for doubtful accounts. I bring this up only because we spent a lot of time in 2110 talking about this idea that not all of these receivables are going to be collected. So from an accrual accounting standpoint, we have to create a what we call a contra asset, and that's an allowance for doubtful accounts, meaning we estimate what accounts are not, what percentage of accounts are not going to be collectible. So accounts receivable as an asset on the balance sheet should be adjusted for it. Remember, we're working on the cash budget, which is building our way to not the income statement, which we've already done, but the balance sheet. So it should be adjusted. So the percentages will be based here realistically on the net accounts receivable. That's accounts receivable minus allowance for doubtful accounts, which is the contra inventory account, and the net accounts receivable. That's what we should be going on. Okay. I don't mean to overcomplicate this, but I do want to sort of bring a bit of realism into this because I think we'd be remiss, at least in my opinion, to suggest that all the receivables that are out there are going to be collected, because sometimes they're not. And it's not always because we're selling to deadbeat customers. It could be sometimes companies that we're selling to have their own cash flow issues and have difficulty paying on time and whatnot, or they've entered bankruptcy, which really complicates things a lot. There's a legal proceeding in federal court that takes a while to sort out. So there are all kinds of issues that are going on. Okay. So some other assumptions in the first quarter, we collected 60,000 was outstanding at the beginning of the quarter. That was the ending of the prior period, as well as an additional 108, based upon 108,000 sales in the first quarter. So that's 108. So 108 plus 60 is 168 altogether, right? Total cash receipts 168. 60 carried over from the fourth quarter. 60% of 180 was 108. 60 plus 108 is 168. In the second quarter, we start again, where we have, again, we collect that 40% that we didn't collect in the same quarter as we made the sales. We collected 60% in that quarter, first quarter. The other 40%, we're going to assume we collected. Assuming we collected all, again, without going back into the doubtful accounts issue, let's assume we get it all, and we get 60% of the current sales of 210, which is 126. 126 plus 72. That is going to give us it's going to give us 198. Okay, and that lets us then build the disbursements. I'm sorry, the receipts part of the cash budget. Okay, so these are the quarters. These are the inflows. This is just collection. So this is just the top portion of the cash budget, money coming in. Okay, inflows. And so what we have here, we had 60,000 left over. These dates are wrong. It doesn't matter. It was 2024 and 2025. That's an error, but it doesn't matter. That 60,000 is carried over. We're going to collect. That came from the fourth quarter as the account receivable as of the end of 12/31 of the prior year. This is a new year. We had 180, which is 60% of 180 in sales. Sales were here, and then we all the way across here. 80% of sales in the second quarter is 126. 80% of sales in the third quarter is 144. All the way across, and we're collecting the other 40% in the other quarter, the subsequent quarter. So as a result, this is the schedule of money coming in. 60% of which is collected from sales in that quarter. 40% will be deferred to the next quarter, presumably all collected. But then whatever is outstanding as a beginning receivable is also collected in that quarter, which is why we have two line items with each quarter: the carryover and the collected carryover, and or I should say carryover and more synchronous, I guess, carryover and more in that quarter all the way across. And so we have these revenue figures for each quarter. I'm sorry, not revenue, inflow figures. These are receipts. And that's the top section of the cash budget, is the idea they were based upon this particular assumption. Okay, again, these are all assumptions, and I don't mean to at all suggest that assumptions are unrealistic or just wild guesses. I mean, they're informed guesses, they're projections, and but they're not wildly overly optimistic. That's usually the experience. Okay, all right, let's talk about the payments now. So remember, so we just talked about the receipts section, money in. Let's talk about money out, and some of the main issues when it comes to money out or paying for the product costs. So let's start with the first, which is direct materials, right? So we have to prepare a schedule for these payments that co-align with direct materials payments. Okay, based upon the idea that direct materials are going to be paid, half the direct materials costs will be paid in this quarter. 50% are gonna be deferred to the next quarter. So we're gonna have a payable that carries over into the next quarter, right? And it's just based upon what? Based upon our experience, our expectation, historical information, whatever. Okay? So we're gonna carry half of it over. Accounts payable 10,600, or what's carried over from the previous period. And we're gonna expect to pay that in full, just for the direct materials part of invoices for the first quarter of this year, which should be 2025, although the previous example got the years wrong, but it doesn't really matter. So here's some of the numbers here. In the first quarter, the Gaines pays balance at the beginning accounts payable of 10,600, which was given to us here, is the idea they have. This is the carryover of an invoice, right? It's a payable, and I'm going to pay in the first quarter. We inherited from the last quarter. Part of that 50%, we are rolling forward every quarter as we incur it. We are deferring our payment for those, right? As well as we're paying 12,600, which is 50% of the current generated direct materials costs. Remember, we're going to pay 50% of the costs which are incurred in the present quarter and kick that other 50% down to the next quarter. So 12,600 is half of 25,200. So 12,600 plus the 10,600 gives us disbursements in the first quarter of 23,200. That's just disbursements for direct materials. Nothing in terms of the other areas just yet. We're going to get to it. Okay. Now that 12,600, which was 50% of the purchases in that first quarter, we still got to pay that. We're going to roll that to the next quarter because we say we're going to pay half now, half next quarter. So we're going to pay that. 50% of 25,200 is 12,600 plus 50% of the new purchases, which in this quarter goes to 29,200. Half of that is 14,600. So the 12,600 that was carried over from the first quarter plus the amount we're paying in this present quarter, 14,600, gives us total disbursements in the second quarter of 27,200. So notice the first quarter we spent 23,200 on direct materials. It went up to 27,200 in the second quarter. And all the way across, we could do it. I mean, obviously it's the same methodology all the way across as we're sort of producing this direct materials budget. But that's the logic that we're doing here. We're saying we're not, just like we sell to customers on credit, we're also buying on credit. And hopefully we're in a situation where we can pay much slower than when we receive our own receivables. That's maybe a wish list for a company, but to the extent that we can slow down our payables, that's all to the good. And some companies will do that. They will stretch out their own suppliers as long as they can. This doesn't make suppliers happy, but sometimes they'll go along with it. And that's a better formula than the opposite formula where you've got very slow receivables and very quick payables. That's probably a recipe for having to raise additional cash somehow, because that's probably not a sustainable issue. Okay. All right, so let's do the expenditure side. And we just simply go back to what we came before. We talked about the idea some is carried over, some is incurred in the accounting period. The accounting period being a quarter, carried over again, 25,200, 12,600 is carried over, 29,200, 14,600 is carried over, all the way across. We have two elements of receipts, some carried over from the prior quarter, some collected in the present quarter. So we have total disbursements. I said receipts, disbursements of 35,200 just for the direct materials piece of the cash disbursement. Okay, but we know we have other disbursements as well, and so and we're going to get to the idea of labor and all the other elements in a minute, but we're going to make another assumption here, and that's the idea that the budget is going to be based upon the following assumptions. Number one, the cash balance, and we're going to carry forward on January the 1st, which is at midnight January the 1st, we're going to inherit the 38,000 that was the ending cash for December 31st of 2024. So remember, one accounting period's ending figure, that's the balance sheet item, becomes the next period's beginning figure. And they wish to maintain at least a balance of 15,000 at all times. This is a policy. This is an internal cash policy. A lot of companies have this. They say we can never drop below X dollars, whatever it is. Now, 15,000 for a public company would not be realistic, but it doesn't really matter. It's the idea that there's a set figure beyond which they can't fall below. Now, why is that? Why would a company say, never, 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 ever, ever would we fall below some figure? Why? What would be the point of that? Why would a company do that, do you think? Anybody on the Zoom call?
So they could meet their liabilities?
True, but also it's a sort of a cushion. Maybe it's not always possible to go borrow money, right? Sometimes banks don't want to lend money. It's possible, even if you have a line of credit, maybe you violated some terms of the line of credit. Some of which we're not really getting into this course, but I do want to sort of bring in this sort of nuance. You can even have a line of credit. The bank says, no, we're not going to lend money because you failed to meet the requirements that we've made. Maybe financial ratios you've got to obtain. Maybe we tried to limit your salary and you've blown past that and you're no longer in compliance. And so sometimes going out and getting money is not always easy. Also, we should mention the fact that sometimes, and we kind of open the door a little bit to this in chapter 14. Sometimes there are opportunities arise where you need cash right now to go do something right now, to go do whatever it is, right? Take advantage of something. Somebody is selling an 18-wheeler for $5,000 or whatever. They're in bankruptcy, it's an estate sale, whatever. We gotta have that 18-wheeler, we gotta go buy it. Let's do it now. We can't go borrow the money, we don't have time for that. We gotta have it now. So sometimes taking advantage of opportunities is one reason why you have cash. This is not, by the way, every organization I can think of has a cash policy where you've got to have something in the form of cash. Always, always, always. Even as individuals, a lot of financial advisors will say, okay, you can have stocks and mutual funds and bonds and all this stuff, but you've got to have some cash, because things happen, and something, an emergency, somebody needs a car repaired or whatever, right? In the case of business, maybe some piece of machinery needs to be replaced, and it's got to be replaced right now. And so, a minimum cash balance is a policy. Again, the 15,000 figure it's obviously reduced to make it a little bit more easy to work with. But again, if you want to slap some zeros on there, that might be the case. But the point is, that cash is going to fluctuate, and if we don't meet that, we got to find a way to get to that. Okay. We're also making some assumptions. Well, we're building the cash budget here. We've already done the receipts portion, and now we're sort of fleshing out the rest of this, because remember what some of the items are on the disbursement section are things like, are we going to buy things like investments, and are we going to sell things, right? So in this case, we're going to sell some investments for $2,000 in the first quarter. We're going to say all the direct labor incurred is paid in the quarter incurred, and that's oftentimes not a great assumption, because payroll, even though it's paid pretty closely to the time in which it's generated, there is a lag period, but nonetheless, that's the assumption. Overhead, all of it's going to be paid in the quarter in which it's incurred. That sort of makes our lives a little bit easier in order to sort of build out the rest of the statement. And so some other assumptions are management plans in the second quarter to buy a truck for $10,000. That's another expenditure, another disbursement that should go in the disbursement section. And they also make estimated quarterly, what we call estimated taxes of $12,000 annually, or $3,000 per quarter of estimated payments. All this is the fact that the government doesn't like to collect all your tax liabilities at the end of the year. They want to get it on a quarterly basis. This has been going on for many, many decades. And by the way, if you as a worker work somewhere and you see taxes coming out, your employer is forwarding those withholdings on quarterly. That's at minimum what you have to make. And so corporations are no exception. And then one final assumption before we flush out the rest of the disbursement section is that we're going to pay off any kind of a loan when we have enough cash available, but we may borrow in order to get us to that minimum cash. So here's what we got. This looks kind of busy, but it's really not that bad when we sort of follow through on what's going on. Remember, we started the year with 38,000. It was the ending cash from 12/31, December 31st of the prior year. And then we have the ending cash of one period that becomes the beginning for the next, ending, beginning all the way across, right? I'm sorry, ending becomes the beginning, ending becomes the beginning, all the way across, right? But here's all the action of the receipts, which we go back to that top section, which we covered before, which deals mostly with sales, right? Collections from customers, the idea that we have a certain percentage of receivables that we collect in that quarter. So we kick down the road, I think 60-40, right? 60% of sales collected in that quarter, 40% deferred to collection in the next quarter, and it goes on and on. We sold securities, or we expect to sell securities in the first quarter. So cash receipts are 170 in the first quarter, plus the original that we started with. So beginning cash plus new cash coming in, it gives us 208 available, and it goes all the way across. We begin at 25.5, we collect 198, 223.5, all the way across. And they become the raw materials for the next quarter. Now we bring in disbursements, and we go back to the idea of direct materials, direct labor. We didn't actually, in this particular cash budget example, drill down too deeply into direct labor, but it's not really that tricky. There's a mild growth over time. Overhead is, all these are expenses that we're going to incur, some of which are non-cash, some of which are not. Now, depreciation is a non-cash expense. We would not include depreciation in manufacturing overhead because we don't run a check for depreciation. And that's something that is not really, I don't know if the text talks about that much, but it's something that kind of keep that in your mind there. And then we're going to buy a truck in the second quarter. That's a disbursement. So we end up with disbursements, receipts, disbursements, excess. Receipts, disbursements, excess. But notice here, we got 12,000 in cash. That's short of the 15,000. So we have to go borrow 3,000 to meet our minimum cash requirement. It's just an internal policy. In the next quarter, we have more cash coming in. We have more cash receipt in this, I'm sorry, we have more cash coming in than we did the prior quarter, and our disbursements were not as high proportionally as they were in the next quarter. So we've got cash available to pay that principal plus the interest of $100. And so we end up with ending cash all the way across. And these are balance sheet items that go on the balance sheet as budgeted for that coming accounting period. Okay. The key thing is that, a couple key things are the idea that we have a minimum cash balance that we're expected to maintain, and that's just given by management. And very often companies have internal policies they've got to meet, and so they want to get to that point. And by the way, this idea of borrowing, even very short term, I mean, this could be second quarter, this could be June 15th, and this could be July 1st. Very, very short term borrowings. When I was a commercial banker, we had people in and out all the time, just coming in to take draws, paying back. Draws being borrowing on a line of credit, paying it back 2 days later, a day later. I mean, it's very, very common that companies want to reduce their interest expense, but they need that short-term facility to do that. And it happens all the time that companies are borrowing, particularly for the most critical things like payroll. Payroll of all the expenses, at least in my opinion, I don't think I'm too far out on a limb on this, is the most critical short-term disbursement that's got to be made. I just don't see any way that you can tell workers it's going to be another week. It just doesn't work. I mean, and we all know this, right? Those of us who have jobs before, we have got to be paid on time. We expect it. So companies have to meet that obligation as well as employers. Okay. All right. Any questions so far about anything on the cash budget itself? Let me see here. And then what we're doing is we're going to sort of work our way toward building a balance sheet. And there's some data as to capital expenditure, buildings and equipment, the accumulated depreciation, all that. And I only have about 2 minutes. I think that it's probably, I have 3 minutes. I'm probably not going to have time to get further into this, but this is a good stopping point because we've sort of covered all the things which are related to the cash budget, many of which are operating, many of which come from those operating budgets that we've been covering the last couple of days. And so now we're going to talk more about what to do with the balance sheet. We're going to build a balance sheet. We're going to try to have a robust balance sheet. There are many people in the accounting and financial world who think the balance sheet's more important than the income statement, just because of the fact that it sort of shows a snapshot and how well management is efficient at managing assets and liabilities. Whether you agree with that or not, there's no right answer. It's a belief but it's nonetheless important, and I can tell you as an old financial analyst, the first thing I would look at is the balance sheet, always, always, always. And then I would look at the income statement. Those are the two most important statements. And I know those are GAAP statements for external users, but they are really telling the tale of what's going on. So to build these prospectively for the year going forward is really important. So this is a pretty good stopping point. Are there any questions I can answer for anybody? Let me see if there are any comments in the chat box. I don't see anything. So, okay, when we come back on Wednesday, we only have just a little bit to go here on this particular module, chapter 15. So I'll spend probably half an hour talking about those. The rest of the time on Wednesday, I'll go through some example problems and exercises from the back, just to kind of give you a flavor for what's coming up on this week's activities. And then next week we come back. We are here Monday and Wednesday. I know that there's a holiday, so I don't know if anybody will be here on Wednesday, but I'll be here on Wednesday. Assuming I'm still alive, right? And so I will get into the very last segment of the class. That'll take us to the next last week. But it's an important chapter that I think in a lot of ways ties together a lot of what we're talking about, particularly the idea of what do we do with these budgets that we're putting together, and what if we're off a little bit? And being off a little bit is better than being off a lot. And so this idea of variance and what to do about them is going to be important. Okay. All right. So that does it. Have a great rest of your day. See you on Wednesday.